Good. Hello, everyone. Welcome to PACE's webinar today on customer profitability analytics. It's something that I've been talking with Dan about. Looking back at my notes for about 20 years, and something that's still relevant today. I'm very proud and pleased to have as our speakers today, Carlos Pulido, Director of Arconis Group, and Dan Hill, CEO of Michaelis Costing Systems. For those of you that aren't familiar with PACE, we're the Profitability Analytics Center of Excellence, a group professional association dedicated to helping organizations make more informed decisions through the use of data analytics. If you'd like to become a member, you're welcome to. It's free. You get access to the multitude of resources available from PACE. Just go to our website, profitability-analytics.org. So we have a little bit of housekeeping here. For those of you who are interested in earning NASBA CPE credit, you must attend at least 50 minutes of the presentation today and answer the three polling questions. Make sure you've used your actual first and last name when you signed in for your certificate. If you didn't, you'll see at the bottom of the screen here, participant. Hover over your name on the list, click the three dots, and choose the option rename to make any changes that are necessary. If you have any questions, please enter them in the chat feature and we'll try to answer them as we go along. And one final note, this session is being recorded, so please keep your camera off and your microphone on mute. With having said that, over to you, Carlos and Dan.
Thanks everybody for joining. Thank you, Rafe. It's great to be here, and I'd like to first introduce myself. My name is Carlos Pulido, Director of Arconis. I've spent more than 25 years working in the profitability and performance management space, of which the first 7 years I worked with Arthur Andersen. I'm sure some of you have worked there before. I've heard the name of Arthur Andersen in the past. So great firm to work for, great experience. So Dan, I'll let you introduce yourself now.
Thank you, Carlos. My name is Dan Hill. I've been an advanced manager of costing and performance management space for over 30 years. I was on the team that helped design, build, and implement the very first true customer profitability system at Bank of America. And since then, I've implemented over a dozen advanced managerial cost and profitability systems across various industries. I was also a co-author of IMA's Statement of Management Accounting, Customer Profitability Management, published in 2011 with Dr. Nabil Elias, a PhD out of UNCC, who is now retired. All right, our objectives for today's webinar. After this webinar, you will be able to do the following. 1, understand what customer profitability is, why it's important, and how to turn its results into actionable insights. Grasp the challenges and advantages in implementing customer profitability analytics in an organization. Also, optimize the impact of customer profitability within an organization through analytics using the visualizations and dashboards. And lastly, bring action-oriented customer profitability analytics to your organization. So those are our objectives for today, and I will now hand it back over to Carlos.
Thank you, Dan. I appreciate that. I'd like to first start off by saying that we should all look at our organizations as a portfolio of customers, not products. So customers are pretty much the organization's main source of revenue. Focusing on a portfolio of customers matters because customers are not equal assets. So treating them as a portfolio pretty much helps a company allocate resources, manage risk, and drive sustainable growth. So it is critical to have the details behind the customer portfolio. For example, understand which customers are of high value, what customers are profitable, which customers are breaking even, and what customers are actually unprofitable, because of course there's different strategies that we need to define around each one of these groups of customers. So the agenda for today's webinar is we're going to talk about why customer profitability analytics matters, what it means, why it's a challenge. A lot of companies are facing a challenge in terms of implementation of customer profitability, and what do you get bringing it to life, and closing thoughts. So we're first going to talk about why it matters. So what would you do? Let's say that you are the CFO of a mid-sized corporation and your boss comes to you one day and demands a 10% improvement to net income. What would you do? Do you have the right information? We have to ask ourselves if we have the right information to make decisions that could improve net income. Revenue and profitability, as we just discussed, comes mainly from customers. So companies that do not have detailed profitability information rely solely on traditional financial statements. So most companies are not even aware of who their best customers are, who their worst customers are, so that they can define a strategy around those customers so that they can become profitable and also understand which ones are strategic and non-strategic. So instead of defining detailed profitability by customer to understand where the opportunities are. So the sad reality is, as I was saying, pretty much most companies do not know who their best and worst customers are. I have a prospect, an aerospace company, and they have about 100 airlines as customers. And I asked the owner, I said, look, what's a list of your top 10 customers and your bottom 10 customers? He said, well, I have to think about that because we don't really have a report with that detailed information that provides all the detailed breakdown of the profitability of each one of those customers. So it is critical to understand this because not only who the best customers are, but without the customer profitability information, most companies do not know that only 10% of customers are actually profitable. Most customers are at a break-even point, and 10 to 20% of customers are actually unprofitable, and some very, very unprofitable. So it is critical to understand the breakdown of the portfolio to make informed decisions that maximize the value of the company. So profitable customers, current and future, are the source of all corporate value. So every dollar of enterprise value ultimately pretty much comes from cash flows, and cash flows come from customers. So if a customer actually doesn't generate sustainable profit today or in the future, they do not create any corporate value to the organization. So that's why this is critical to understand that customers sit at the heart of the organization. They bring in revenue. It is important to understand the detailed profitability of each one of those customers. So again, we can make informed decisions. There's different strategies around each one of the customer groups that need to be defined. And of course, you're not going to have the same reaction towards a customer or customer group that doesn't generate any value or any profitability versus a customer that actually generates profitability. You may be more reactive or more proactive towards certain groups of customers in this case. So again, why it matters. Here we see an example of a whale curve. I'm sure most of you have seen a whale curve or have heard of a whale curve. In this case, the whale curve shows a cumulative profitability of the customers, as you can see. So the way we build the whale curve, as most of you know, is that we organize the customers by profitability for most profitable to least profitable in this case. So as we see on the y-axis, we see how the profitability keeps on growing, right? Because of course, the very first profitable customer, we have it at the very top of the list. Then we have the cumulative profitability of the second customer, which is the profitability of the most profitable customer, plus the profitability of the second one. So we see how all these customers that are actually generating a profit to the organization are are on the steep side of the curve going up. And then as we see how the curve flattens out towards the middle of the curve, we see those are the customers that are actually breaking even. And then as we go to the right, as they keep on falling or the curve keeps on falling, we see those customers that are actually not generating any profitability at all. So in this example, we see that a company lost actually $7.3 million from their unprofitable customers on the right-hand side. And that's an 11% loss from their final net income of $65.9 million. So how would you fix the profitability if you wouldn't know the profitability of each one of these customers, or you wouldn't know who's generating what type of profit for the organization? So it's easier to look at the customer profitability this way or look at the meaningful information by looking at the well curve, and then defining a specific strategy. Maybe, for example, we can go ahead and for those customers that are actually breaking even, we can go ahead and say, well, why can't we just make them profitable? What are the different steps that we need to take? Do we need to look at the cost to serve? Do we need to take a look at the actual products that they're purchasing? Do we need to look at any cost drivers like number of orders, like specific delivery routes that they're taking that it's making them unprofitable? So it's easier to make those type of decisions by actually looking at the well curve or the detailed profitability by customers. Okay, so a lot of organizations look at their profitability from a product lens, and and organizations stop their profitability model at the product profitability, right? Which is way more information that a lot more companies actually currently have. So in this case, we see on the right-hand side, we see most profitable products on the left-hand side, and we see the ones in the middle that are breaking even, and we see a few on the right that are actually destroying profitability. So it's good to know, right? We have the product segments, product categories, we have the SKUs individually, and product profitability helps with the product portfolio mix. It helps with the product pricing and cost structures. It helps with the product grow, maintain, abandon, and it helps with the product level strategic direction. However, we have pretty much averages at this point at the product profitability level. And here, but product profitability also uses the product costs that are averages across customers. So as we can see on the left-hand side on the chart, we see the most profitable product, and then we see broken out by detailed customer profitability. So we have 31 different customers that are actually purchasing product 31, and we see that only one customer generates $723,000 and another customer on the right-hand side that actually loses $136,000. So as you can see, even though that product is very, very profitable, it's pretty much the most profitable organization. There's a very, very wide variation of profitability when we look at the 31 customers that are actually purchasing that product. So there's different behavior, there's different cost drivers, there's different cost to serve associated with every single one of these 31 customers that are actually making this product unprofitable in certain situations. So it is important to understand the detailed breakdown of this so that we can dig deeper and find ways to improve the profitability of the most unprofitable customers or the break even. Granted, you're always going to have certain unprofitable customers. I haven't really seen an organization that pretty much every single product, every single customer is profitable. However, at the same time, those unprofitable customers or products that are breaking even are still consuming some of the fixed costs of the organization. So, because we had one time asked by a manufacturing organization, the manufacturing manager was saying, "Okay, so great. Why don't we just get rid of all the unprofitable customers and focus on the profitable customers?" That's fine, but that doesn't mean that you're going to automatically improve your profitability because those unprofitable customers are still consuming the fixed cost of the organization. So by you getting rid of those products, the fixed cost that was consuming by those products is actually going to shift to the other products that are actually making a profit. So they may still be profitable, but they won't be as profitable as they currently are. Okay, so when we look at the product, customer, and behavior lens, so we expand the company's modeling to customer profitability, and it opens significant strategic opportunities. So customer profitability, as we have mentioned so far, provides profitability and value added at the product and customer intersection, customer and product pricing strategies, product cost and cost to serve, marketing goldmine. So customer type to attract or avoid. It gives you the visibility of the product mix to maximize the value. It also gives you the visibility to pretty much a channel mix to or optimize the delivery. So in this case, we see on the chart we see customer 1985, we see the profitability by product where we have 6 different products that this particular customer is purchasing, and only 1/3 of the customer's accounts are actually profitable. So we see that there's one that's very, very profitable on the left-hand side, 3 that are unprofitable, and pretty much 2 that are breaking even in this point. So it's more meaningful when we have this type of information. So we have total profits of $17,000 where we have product one generating almost $20,000. So more than the profitability of all the products is actually being generated by only one product in this case. So in this case, of course, there's different strategies that we can define around the to maximize, improve the profitability of this particular customer. So yeah, why it matters. So companies that have not yet implemented a customer profitability system, they actually lack the complete picture. As you can see, uh, pretty much there's incomplete information, right? Typically, most companies just stop at the product profitability level, like we have talked before. They don't know which customers are actually profitable. They don't know which customers are unprofitable. They don't know where customer value is created. This is key, right? So that we can make some changes in the organization so that we can maximize the value and the return of the organization in this case. So now it's time for a current poll question. So the current state. Um, so how does your organization currently measure profitability? Please provide us with your answers. Option one is organization, by product or service level only, by customer level, limited or partial, e.g. segments, by customer level, comprehensive and trusted, or we do not measure profitability in a structured way. Please provide us with your answers. So we'll just give you a few seconds here. And Ray, if you'll provide us with the answers shortly.
Yep, we're just getting a few more responses here. Please enter your response soon so we can end the poll and share the results.
Oh, great. Perfect. We see that most of you answered option one, which is organization, product, or service level only, right? No surprise, because given the fact that most organizations are not at the customer level yet, there's 16% of you that actually answered customer level, which is great. And the last one, 26%, we do not measure profitability in a structured way. So there's a lot of opportunities right there to implement an enterprise-wide profitability model by customer or segment. Okay. Perfect. Yes, there's a few questions out there in the chat. Yes, we will provide everybody with a PDF copy of today's presentation. So thank you for asking. So next topic in the agenda is what it means. So please, Dan, go ahead.
Thank you, Carlos. Okay, what does customer profitability mean? Well, let's start by defining it. Customer profitability simply is revenue by product less your product costs, your cost to serve. Now, we're going to make the case continuously during this presentation this morning. The cost to serve is really driven by customer behavior. Product costs are pretty customer independent, just depends on what products and how many you buy as to what the costs are. But when it comes to cost of service, it's very much driven by independent customer behavior. And also, some companies include overhead. However, overhead is not a causal-based cost, so probably shouldn't be included in your product customer profitability. But that's really a subject for another day. All right, what we have here is a customer profitability statement where you've got each column gives you the customers that you have in the organization. Revenue is pretty straightforward. It does vary by customer depending on product and number of units purchased. The cost of goods sold here again is going to vary by customer based on products and units purchased, but other than that, it's pretty independent of the customer. But cost to serve is really driven by customer behavior. So what do I mean by that? Here we've got order processing, $45,000. Well, where does that come from? We happen to have the data down here at the bottom. The number of orders by this customer, 1,250. Pardon me. The cost per order, $36, gives you $45,000 in cost. Customer service, well, let me see. There were 340 service calls. The cost per service call, $102.94. Or $35,000 in customer service, and so on and so forth. But the main point here is these cost to serve costs are driven really by the customer's behavior. How many orders did they make? How many deliveries were done? How many service calls did they place? How many returns did they make? Those really do drive the cost of service, and it really does change by customer. Now, it's kind of interesting here. If you take a look, customer 2 is their most profitable customer here in this statement, at 22.4% net margin, but their ratio of cost to serve to revenue is 11%. We go over to customer 3, which is the least profitable customer in this chart, 2.8% net margin, and their cost to serve ratio to revenue is 21%. So 11% versus 21%, from very profitable to marginally profitable. Cost to serve are a big deal. We need to understand them, and it really is driven by the behavior of the customer. Okay, now when it comes to building a customer profitability system, revenue is rather straightforward. There are some challenges, but overall, it's really not difficult. Now, it is easier if your customers have accounts and buy multiple products. Now, there's also challenges by industry, but they're usually not too bad. Manufacturing considers a discount waterfall, sorry. That's what you see here on the right. Banking needs funds transfer pricing. You need FTP in banking to understand revenue at the product or customer level. Retail businesses often use loyalty cards to keep track of their customers and the revenue and transactions by customer. Now, when it comes to building customer profitability system, however, although revenues are rather straightforward, costs are not. Costs are a huge challenge. Costs are very difficult to do right and really do require some sort of causal-based cost assignments. And that requires an advanced managerial costing approach, such as activity-based costing or time-driven activity-based costing, which does require some level of costing expertise. You have a little assignment chart on the right. This is very simple. This is one tiny piece of a huge allocation model. But you've got wages going down to bonuses, and then the chart shows the bonuses being charged out to each of the respective products that the company offers. Simple, and as I said, it's just a little piece of a much, much bigger model. Okay, let's bring capital into view. There's something called customer value added that actually brings into view the economic cost of using capital. Now, this does require internal capital assignments all the way down to the product or customer. And this can be a little tricky. The methodologies range from pretty simple to extremely complex. But once you can get over that hurdle of assigning capital down to the product and customer, now you can do customer value added. And customer value added is merely customer profitability less a charge for capital. And that charge for capital is determined from the capital that's assigned times the cost of capital rate. Now, the cost of capital rate is an internal rate that's determined from things such as the weighted average cost of capital, your hurdle rates, capital preservation objectives, things like that. Okay, what we have here on the right is a customer value added decile chart. And each bar represents 10% of the customer base sorted from most profitable to least profitable. And as you can see, most of the value of this organization is created in the first two deciles. Okay, I want to spend a minute talking about multidimensional analysis, the multidimensional view. Every costing and profitability system out there makes a big deal out of the fact that they offer multidimensional analysis. Buy our product because we'll give you multidimensional analysis. Folks, multidimensional is built into these systems. I've never installed a costing or profitability system, both across commercial and homegrown systems, that did not include a multidimensional view. And if you do your model buildings at a low level, such as the sales transaction, the instrument, or the account level, you can therefore then have the various dimensions available to you in the data. Things like customer, product, channel, region, just about any dimension that's in the data that you can see. Now, once you have this, you can slice and dice your data based on a single dimension or a combination of dimensions. And you can also take those dimensions and roll them up or aggregate them through dimensional hierarchies. Just to kind of give you a feel of how simple multidimensional really is here's a typical table where you've got your dimensions on the right, your year, month, account number or sales transaction, product, customer, salesperson, office, and then your data here on the right. That's pretty typical. Well, dimensional or multidimensional analysis is very similar to using a filter in Excel. If you wanted to look at only the products customer 1577 buys, you would just filter this table by customer 1577. You've just done multidimensional analysis, very similar to using a filter in Excel. And just to take this one step further, if we were to slice and dice our table by the product column, we would end up with product profitability. If we sliced and diced it by salesperson, we'd end up with salesperson profitability. By office, organizational profitability. And of course, by customer profitability. Now, you notice these are just different ways of looking at the exact same data. And therefore, you have this truism at the bottom. The sum of total product profitability equals the sum of total salesperson profitability equals the sum of organizational profitability. It's just different ways of looking at the exact same data. All right, let's pull it all together. The objective of customer profitability analytics is to produce insights that lead to measurable actions, and actions, hopefully, that optimize corporate performance. Okay, we have come now to poll number 2, use of insights. How are customer profitability insights used today in your organization? You use it for strategic decision making, such as pricing, segmentation, investment, tactical operational decisions, reporting only, a limited action taken, are not currently used. And we can all make our choice and submit your poll, please. And then in just a moment, Rafe will be able to pull out the results of that poll. We can see what people had to say. And here we go. Okay, about 30% of the folks are using strategic decision-making, pricing, segmentation, investment. That's great. About 20% are using tactical, operational decisions, a little bit more short-term, but that's still very good. Reporting only, that's going to be kind of limited for you. And then not currently used at all at 30%. All right, moving on here. Why it's a challenge. Back to Carlos.
Thanks, Dan. I appreciate it. Okay, so why it's a challenge? Most of us pretty much are used to seeing financial statements, P&Ls, balance sheets. So GAAP is a huge roadblock to customer profitability. We have pretty much general numbers here. We have revenue, we have just expenses and net income. People consider GAAP the financial Bible of the organization, but it's just a tool. It's just to meet requirements, and GAAP data is too aggregated to understand customer dynamics. So if we look at this picture here, if we look at this report, a P&L, very simple P&L, how could we make strategic or managerial operational decisions just by looking at these numbers, right? It is not as easy as if we had more detailed and meaningful information. So why it's another two more challenges that we're going to be discussing is the use of averages is a common but hides critical details. So we have product profitability averages across customer behavior, just like we looked in the earlier example, where we have the product profitability. However, we don't have the visibility into which customers are actually more profitable, less profitable. And then account officer averages hide on profitable deals. And then the other challenge is that we have broad-based cost drivers that are a killer to the profitability visibility of the organization. So we have cost spread using number of accounts or percentage of revenue, sales. And so that way we're pretty much assigning the cost just by using a couple of drivers to all the different hundreds, if not thousands of products. So that way we pretty much hide the truth of the profitability of each one of those products and customers. Here we're going to look at a couple of examples. So this one is an example of how averages hide details. So averages have a way of hiding important details. Like we see here in this chart, we see the detailed profitability by products by product 27, and we have when purchased by the customer. And so we have pretty much the 25% of the customers that are above the average of $33,000. We have total profits of $4.3 billion for 131 customers that are actually purchasing product 27. So as we can see on the left-hand side, we have 25% of these customers above the average of $33,000. And then we have 75% of the customers below the average and a small number of customers that are actually being unprofitable. So this is the detailed view of how we don't have the averages anymore. We just have because if we only look at the actual average of the total profits for this product, we lose all the visibility of the detailed customers that are actually purchasing this product. So by having this detailed information, we can actually define specific decisions or strategies to make informed decisions to maximize the value, the profitability of the organization, right? Like as I mentioned earlier, we're always going to have a few customers that are actually not profitable, but at least we understand who they are, what they do, and what their behavior is so that we can control their profitability in a way.
So
Okay.
someone just asked the question,
Yes.
what's the difference between customer profitability analysis and customer profitability analytics?
Oh, I'll jump in there, and I
Go,
don't really
go.
think there is a difference. It's just a different way of saying the same thing.
Mhm.
Carlos, would you agree with that?
I would agree with that, Dan. Yep. Thank you, Dan. So here's an example using broad-based cost driver. In this case, we're pretty much using just revenue as a driver, and pretty much as you can see, standard costing, right? We have so high-level cost drivers, for example, revenue that we're assigning to these customers A, customer B. The advantage is that we can easily calculate profitability for every customer product, right? We're pretty much not making a big effort. And cost, however, costs are a dilution with no causal relationship. As you can see here, we're actually assigning revenue to customers A, customer B, and all customers have the same 20% net margin, right? Because we're pretty much using revenue to allocate these expenses. We're not looking at the detailed breakdown of all the expenses. We're not looking at the causal relationship and assigning specific drivers. So that way we can have the true cost or a directionally correct cost across all the customer base and all the different products that we are manufacturing and selling to customers. Okay, so two big pitfalls. So people resist change, especially measurement systems. So resistance to change can be minimized and countered with transparency, wide participation, balanced approach, established principles, and there also increased trust in the model. So pretty much a lot of executives at any organization, they resist the change. They say, "Wait, why do we need to have detailed information? This is going to be a lot of work for the organization. We have to go through all the different steps to implement a detailed system with profitability information." But customer profitability is actually not a one and done job. It's a continuous improvement project. And so, because oftentimes back in the day, in the early 90s or late 80s, actually, when a lot of companies started implementing detailed profitability models, they were so complex and they stopped at pretty much a model one, model two. And models were so detailed, and technology back then was not advanced that companies spent more time actually building the model instead of analyzing the models to make informed decisions. So I think it's important to have transparency, wide participation, balanced approach, and established principles that provide purpose, modeling approach, and usage of the model and the information. So we're now at poll number 3. Please provide us with your answers. The question is, what is the biggest challenge in implementing or using customer profitability at your organization? Is it accurately assigning costs to customers, data availability and quality, model complexity, lack of transparency, or operational organizational resistance or lack of buy-in? Please provide us with your answers. Yeah, a lot of organizations are having different challenges. In this case, we have most of you responded accurately, assigning cost to customers. I think I'm not surprised. We see a lot of organizations, a lot of leaders that are actually not clear on how to assign cost to customers. And what we always say in this case is that we always have to look at the pretty much think of at the Pareto analysis, right? 80/20, where we look at those 20% of the accounts or the expenses that are actually generating 80% of the costs. We want to make sure that we group them into cost pools, make sure that we analyze all the detailed expenses, all the detailed costs, define a meaningful driver to assign the cost to products. Nowadays, a lot of tools or software tools pretty much provide the users the opportunity to conduct reassignments, assign first cost to products and then to customers and vice versa. So it is important, it is critical to identify those specific customer related costs so that we can accurately assign those costs to different customers. So thank you. Now, moving on to the next item in the agenda is what you get. Please, Dan, take it away.
Thanks, Carlos. Okay, what do you get out of a customer profitability system? Well, it certainly gives some actionable insights to the CFO, such as where to invest in your profitable customers, your growth products, your strong organizational units. How about where to reprice, where to restructure? Well, you can look at your break even and unprofitable customers and your marginally profitable products with potential or possibilities there. Now, what you have here on the right is a chart. It's just the customer profitability deciles, where similar to the value-added deciles, each bar represents 10% of the customer base, started from most profitable to least profitable. And you can see here the top 2 deciles is where all the value from this organization is being incurred. And therefore, that's probably where you want to invest. You want to be sure to retain those customers and attract more like them. On the other hand, your bottom 4 deciles are all unprofitable. Maybe this is an opportunity to reprice or to restructure. Now, CFO can get a lot of insights from customer profitability beyond just understanding customers. Economic cost modeling can yield many benefits, such as highlighting inefficiencies, overspending, capacity, awareness of cost leakages. It can help identify cost reductions. So what we have here is a chart that we've seen a couple of times so far in the presentation. It's product profitability across customers. This is product 19. 77 customers buy this product, generates $40,000 a year in profit. Not much, but it is profitable. Nonetheless, what you're seeing is about 40% of the customers that buy this product do so unprofitably. Are there cost leakages going on there? Now, we do have a question mark there after the cost leakages because there are reasons customers will be unprofitable. New accounts, for example, lost leaders, that sort of thing. But after you filter all that out, are there any opportunity to see where there are some cost leakages for this product when it comes to these unprofitable customers using this product? Now, once you've got customer profitability, you can also do some add-on analytics, such as customer lifetime value, product lifetime value, and improved forecasting and budgeting. Now, the forecast and budget brings up the idea of a push budget versus a pull budget. When you build these profitability systems, you usually do it from a push perspective. You start with your resources to activities to your final cost objects. But then once you've got the system built, you can then do something called a pull budget, where rather than starting with the resources, you start with the demand. What are your customers demanding? How many products do you expect to sell? Once you fill that in, then the model can work backwards and tell you what resources are required to fulfill that demand from the customers. How many FTEs you're going to need, machine hours, things like that. It can offer an awful lot of valuable information once you have a solid customer profitability model built. So here's an example of inefficiencies. This is an efficiency ratio chart by salesperson. Now, the efficiency ratio is just total expenses divided by total revenue. So the lower the efficiency, the better. The lower the efficiency ratio, the better. And what you can see here with these salespeople, you got these salespeople, number one, they're unprofitable. You can tell that because it's red. But anytime you have an efficiency ratio over 100%, by definition, it's unprofitable. Your costs exceed your revenue. And therefore, all these salespeople are really producing in an unprofitable and inefficient manner. How come? Why do we have some very efficient salespeople and some very inefficient salespeople? That would be something I would want to dig into. Okay, some other advantages for the CFO is the strength of customer profitability really comes from its granularity, where you can drill down to any dimension in the data, in particular customer or product, for example. Now, it does provide one source of economic truth if it's trusted by the organization, and that way each manager is not out coming up with their own analysis to challenge you. And of course, the objective isn't reporting, but improving real decision making to drive optimized performance. We go from customer profitability to insights to action. Okay, now if we have a customer profitability system, we certainly want to maximize its impact. So here's a couple of suggestions. We should work to employ that system throughout the organization. We need to make sure the system users have tools that are easy for them to use and fit for their purpose. And absolutely mandatory that the trusters must trust the results, or they will totally ignore them. Now, when it comes to communicating the results of customer profitability, best practice is to use visualizations and dashboards. Tables of numbers are very boring for most people and scary for some. So many people have learned visually, not textually. So a really good idea when it comes to communicating these results is not to go with the tables and numbers, but to go with visualizations and dashboards. Okay, now we're going to enter into bringing it to life to make it actually happen. And I'm now going to switch applications here and bring in Tableau, bring it into the screen here. And I hope you all can now see it. Okay, customer profitability deciles. We saw this chart during the presentation where each decile represents 10% of the customer base sorted from most profitable to least profitable. Now, what really stands out about this chart is 97% of the value of this organization comes from only 10% of their customers, 97%. Why is the distribution so skewed towards the top 10%? That's something we need to understand. Now, we can also look at this from a value added perspective. Let's bring capital into view and look at value added. Well, now, first, right away, you may notice that this top 10% drops from 64 million in profitability to only 33 million in value added after you take out the cost of capital. And we see that there's a big chunk, our most unprofitable customers are actually taking away quite a bit of value. Now, in the profitability chart, this top 10% generated 97% of the profits. That's not the case here. Here, the top 10% generate 130% of the profitability, and these last 90% destroy 11 million in value, bringing the end of the day, it's about 21 million. So this is actually 130% of value added and then is destroyed by not necessarily all of the 90%, but by these bottom 5 tiers. Move that back to profitability. There we go. Now, we also saw the well curve during our presentation, where the well curve is cumulative profitability by customer. First customer's profitability, first and second, cumulative profitability, first, second, third, so on and so forth. And as Carlos explained, the curve goes up really fast and kind of levels off at your break even, and then you see the downturn from your unprofitable customers. Now, this organization lost 7.3 million from their unprofitable customers. They could have earned 73. They only ended up 65. But let's look at the same thing once we take into account capital and look at value added. Now we see that our value adding customers add about 38 million, but at the end of the day, we only end up with 21 million in value added, a loss of over $16 million in value added from our profitable customers. These guys off here to the right. Another thing you'll notice, you got little blue lines along here. What these are customers who were profitable before we took into account capital. Once we subtract the cost of capital from these profitable customers, they go underwater. So just looking at pure customer profitability sometimes can be a little misleading if we don't consider the capital that we have to use to service that customer. All right, another chart we saw in the presentation was total product profitability. This is a very simple chart. You could probably do this chart with a product profitability system and not even have customer profitability. But you can see up here the most profitable product, the most profitable products, the most profitable product being product 31. But we can dig into these like we did in the presentation and look at a particular product and the profitability across all its customers. This product, 19, for example, has 77 customers, makes $40,000 a year in total. And we've got some very profitable users of the product, some not so profitable, a lot of close to break even, and then some very unprofitable users of the product. So I find that fascinating. But you see this pattern again and again. Now, we saw that the organization's most profitable products, product 31. So why don't we, just for kicks, take a look at that? We come down and take a look at product 31. And there's a lot more customers here, 341 customers, why those bars are a lot smaller. But it generates, wow, $17 million in profits per year. This is a very profitable product. And yet you've got wide variation between the customer and how much individual customers make using this product. We've got one here, as we mentioned in the presentation, that I think $700 some $1,000 this first customer makes. And then down here at the very right-hand side, you've also got a customer that loses $136,000 on the very same product. This gives us such a wealth of information to understand what we're doing with this product and how our customers are actually behaving when they use this product or buy this product. Now, you tend to see the same pattern when you flip it around and you look at a customer that buys multiple products. In this case, you've got customer in 1985, bought 6 products, their profitability is $17,000, and yet only 2 of their 6 products that they purchase are profitable. Here again, we covered this during the presentation. But it's important to understand that when you look at the customer level, we also need to look at what products they're buying to fully understand what's going on with that customer. Now, we can also look at salesperson's performance. In this case, we're looking at a single salesperson 57, has 335 customers, makes $154,000 a year. Not bad. This is a histogram of the results. The surprising thing here is, although they have 335 customers that the salesperson services, 2/3 of them, or 236 of the customers, are underwater, unprofitable. Only 1/3 of the customers make money. Why do we have this situation? What's going on here? If we can understand this, we can hopefully help this salesperson become much more profitable. Now, you can also look at salesperson's performance by products rather than by customers. So this is a different salesperson. Salesperson 58, they sell 15 products. They generate over $1 million in profits. That's pretty darn good. But here again, you can see it varies widely. So a couple of the products they sell are very profitable. A bunch of them are break even, and then 2 or 3 of the products they sell are rather unprofitable. So here again, a very profitable salesperson, if you just take their total profits, you'd be completely, you wouldn't have any idea that only some of the products they sell are profitable and some they sell are unprofitable. Now, another handy analysis that we like to use is a cross-sell analysis, where if you say, okay, customers that buy product 11, what other products did these customers also buy? Well, for this particular organization, product 5, product 21 is actually a complementary product of product 5. So when they took a look at this and saw that 6,700 customers purchase product 5, but only 227 are buying the complementary product 21, what's going on? Is it our marketing? Is it our proposal? Or is it something else that's causing these folks not to buy the complementary product? Or maybe it's not as complementary as we think it is. Now, I got a couple last charts here to talk. The efficiency ratio is total expenses behind total revenue. Here again, we covered this already. Efficient salespeople, inefficient salespeople. What's going on here to the right? But you can also look at efficiency not only by salespeople, but also product. How are our products serviced in an efficient manner or non-efficient manner? And here you have very efficiently delivered products, very inefficiently delivered products, and you actually have some that are underwater. Why are these guys negative? And these products, even though they're making a little bit of money, they're still very, very inefficiently delivered. What can we do about this? Why are we losing so much efficiency with these products here on the left-hand side? Okay, that's just kind of an example of some of the analysis that you can dig into with customer analysis that actually can, in many cases, you can go well beyond customer analysis or customer profitability. So let me pull this off the screen here. And now we're going to go to closing thoughts. And I'm sorry, Tableau dashboards, closing thoughts. And Carlos, back to you, sir.
Thank you, Dan. So pretty much what we've covered today is that customers are at the center of all we do. Customers create value, but not all customers create value equally. That's why it's very critical for us to understand the detailed profitability by customer, by product, by customer segment, and by all the different products that they purchase. Without measuring customer profitability, we manage growth blindly. And profitable customers fund the business and fuel and future success. So typically, unprofitable customers erode margins. Correcting them can unlock anywhere from 10 to 20% of total profitability. I also wanted to share something important. We have a client, it's a insurance agency, and they have about 4,000 different customers. And what they told us is that they're actually currently they have a big churn, and they didn't realize that they had this churn until they looked at the financials in detail. They currently don't have any customer profitability information, but they said, "Look, we want to grow." I said, "Well, you want to grow, but you first have to make sure that you control that leakage because it's easier for you to control the churn than to start growing again." So, what we did is that we actually completed a detailed profitability model by customer. We identified those customers that were more profitable, less profitable. We identified or segmented the profitability of those customers for the customers that were actually leaving the company. And then we defined a very specific strategy to retain those customers that were more profitable and where we were being more reactive towards the customers that were actually unprofitable. And the results increased, pretty much controlled and increased profitability. And now we are at a stage where we can start growing. So, bottom line, it's very critical to understand customer profitability to make informed decisions to maximize the efficiency, effectiveness, and value of any organization. Thanks a lot for your time. Thank you, Rafe and Toby. We have here our contact information. Please reach out to us if you have any questions, any comments, or if you want a copy of the slide deck. We're more than happy to provide it to you.
Carlos, we do have a question in the chat. Why don't we?
Oh, yeah, Jay has a question. Is it better to apply some costs to the best allocation method, even when its true correlation is not clear, or should these low correlating costs be ignored?
I'll tackle that if you don't
Okay,
mind,
that's fine then.
Carlos. It depends if there's any causation or not. Just because there's correlation doesn't mean you've got causation. For example, we gave an example of using revenue as the cost driver. There's correlation between revenue and expenses. Usually, as revenue goes up, expenses go up. But there's really no causation. It's the revenue. It's not the revenue that's causing the cost. It's pulling on those resources to deliver the product that's causing those costs. So it's really quite independent of revenue, although there is a correlation there. So I would say if there's a correlation but no causation, I would ignore the cost because now you're talking about something that's called an attributable cost as defined in the conceptual framework of managerial costing. You should ignore those costs. They should not be included in your product or customer level because there's no causal relationship. Those costs should be charged at the level of the organization that controls those costs. So causation is not enough. Correlation is not enough. You really need causation to apply. And then, of course, you want to use the best allocation method you can once you do have some causation there.
Perfect. Thank you, Dan. There's another question from Benjamin. How does organizational culture impact customer profitability? I guess, Benjamin, twofold. One is, of course, the organizational culture could be pretty much a stoppage to the actual model build, right? The initial model build, the profitability model build. And then organizational culture, of course, it depends on the behavior of the different employees or leadership towards customers. the fact that they have a sound strategy, that is the culture of the organization, to regularly review the bottom line of the organization, and the fact that, how well they treat customers, how thorough they are reviewing their numbers. So it could affect the customer profitability, depending on um, how the organizational culture changes throughout the different departments or the different organizations and different industries. So Dan, I don't know if you wanted to add anything else here.
Oh, no, I thought that was great. We do have another question, so we can move on if that's all right. You discussed some of the concerns and challenges in implementing a customer profitability system. What would you say is the biggest challenge, the highest obstacle to overcome when implementing these systems? Carlos and I might disagree on that. I'm not sure. I would say organizational resistance. I mean, you do got to have executive buy-in and all that, but once everybody's on board, let's get this done. Organizational resistance, people's resistance to change is going to get in your way every single time. You really have to manage that through some sort of change management program. Carlos, did you want to add to that?
Thanks, Dan. No, I think we actually agree there. So thank you.
There are a lot of challenges. Data
Yeah,
quality, data can be a big problem.
yeah,
Do you have the data
yeah.
and
Data
and
quality.
in shape?
Mhm.
I mean, so there are many challenges, but here again, I would put people's resistance to change as the
Is the
biggest one.
main one.
Yeah.
I agree.
I think that is all the questions we have so far. Any more questions out there? We're just about out of time. We got 1 minute left.
Yeah, thanks everybody
Let's
for
move to the
joining.
next slide, please.
Oh, I'm so sorry, Rafe, of course.
So thank you, Dan and Carlos, for that great presentation on customer profitability analytics. I think this topic has always been important, but in this day of artificial intelligence and other technologies, it's even more important than ever, where companies that are employing these technologies really can analyze their customer profitability and get us a lead on their competitors. So it's again such a critical topic for companies to be aware of and implement systems like this. So thank you for sharing this with our members and our wider audience. So I just want to again thank everyone for attending today. If you want to become a member of PACE, it's free. Just go to our website, profitability-analytics.org, and sign up. The replay, this has been recorded, and the replay will be available to our members. And if you want our webinar calendar, check out our site on LinkedIn, Profitability Analytics Center of Excellence. Any questions, comments, or suggestions, feel free to contact me, Rafe, at profitability-analytics.org. And with that, again, thank you, Dan and Carlos, for a very interesting session today.
Thank you, Rafe and Toby.
Thank you, everybody.
Thanks,
Appreciate you
everybody.
attending.
Bye bye.